Hey guys, I'm Matt. In this video, I'm going to walk through my analysis of the insurance company Allstate, ticker symbol ALL. On this channel, my goal is to log my personal journey to financial freedom while sharing my portfolio and positions, and show how I'm accomplishing this through disciplined saving and smart investing. Let's jump into this stock and see why I think it's a smart investment after the intro. Allstate is a general insurance company that has over 10,000 exclusive Allstate agents. In addition to that, 5,000 independent agents that sell Allstate policies. These agencies write policies for home, auto, personal lines like life and renter's insurance, and also commercial lines, which is directed towards businesses. That's a lot of different policies, but if we take a look at Allstate's revenue segments, about 83% of its revenue comes from property and casualty insurance. This is by far its largest segment and includes its policies that it writes for home and auto. If we take a look at its second largest revenue segment, that would be its net investment income. This will make sense when we look at Allstate's balance sheet to figure out where that's coming from. Its third largest segment is from life insurance premiums and contract charges, which come from the term and whole life insurance policies that it sells. Before we get too far into analyzing Allstate, let's really understand how insurance companies make money, because they have a very unique but very good business model. This is the same business model that attracted Warren Buffett when he started investing, and some of these insurance companies came out to be some of his best investments. So let's dive into that. On a very basic level, insurance company writes policies to cover expenses in extraordinary circumstances like car crashes or natural disasters like earthquakes or floods. They collect a large amount of premiums on these policies and they turn around and invest it. So while they are collecting revenue or premiums on these policies, it could potentially be a liability because claims can be filed against them and they need to be ready to pay those out. So this money that they get that is still a liability is commonly referred to as float. So with this float, they'll invest it in very safe short-term income securities to get a return on this very large amount of money that they have, but they also need to be ready to pay claims on. To analyze how profitable an insurance company is and how efficiently it's being run, let's look at some specific industry ratios that people use to analyze these companies. The three most important ratios to look at for an insurance company are the loss ratio, the expense ratio, and the combined ratio. The loss ratio is important because it shows the amount of claims that the insurance company has paid out as a percentage of its underwriting revenue. So if we look at the past 6 years, Allstate's loss ratio typically stays between the 60 and 70% range. Now if we take a look at the expense ratio, this is the ratio that shows the amount of money that it pays to run the back end of the business, like sales, marketing, admin, and takes those costs as a percentage of its underwriting revenue as well. This ratio has also been pretty consistent for Allstate and is typically around 25%. Now, if we add these two ratios together, we get what's called the combined ratio. And the combined ratio is important because it really shows you the amount of expenses that it pays out to fulfill its underwritings. The combined ratio is important to look at because if it's under 1, this means that the insurance company is collecting a margin on its policies that it's underwriting. And fortunately for Allstate, it's been doing a good job at improving its margin on its underwritings over the past 6 years. 2020 was an unusually good year because it had a lot fewer claims due to COVID and less people being outside and less economic activity in general. But Allstate has definitely been improving this ratio over the past 6 years. All right, so this is great. Now when we look at the earnings of Allstate, we know that it's really divided into two different components. One, the money that it's earning on investing the float that's collecting on premiums, and second is the margin that it's actually getting as the difference between the combined ratio and the revenue that it's collecting on its policies that it's underwritten. Now, if I pull up Allstate's income statement, we can see that Allstate made about $5.5 billion in 2020, and this comes out to an EPS or earnings per share of about $17.67. And if we look at Allstate's price to earnings, it's about 6.4, which if you're used to analyzing other companies, that is incredibly low. And it's important to remember that when analyzing an insurance company, do not use price to earnings ratios solely. Most investors like to look at the price to book ratio. Now, the price to book ratio is very simple to calculate. All we have to do is take the price of the stock and divide it by its book value. Book value is the same thing as a company's or shareholder's equity, and equity can be found on the company's balance sheet and is equal to the company's assets minus its liabilities. So let's take a look at Allstate's balance sheet. If we look at the asset side of Allstate's balance sheet, it's divided into two segments. It's total investments and another segment which includes more typical assets that you'd find on other companies' balance sheets like cash, accounts receivables, deferred expenses, property and equipment, goodwill, and other assets like that. If we look at Allstate's total investments, it has $94 billion invested, which is a lot of money. But like I was saying earlier in the video, most of what insurance companies invest in are very safe short-term income securities. So the first line, fixed income securities, it has $66 billion invested. That's going to be in like treasuries and bonds. And the other sections can include its investments in other safer companies like utility equities, mortgage loans and other mortgage-backed securities, and other shorter-term safe investments. And here on the liabilities and equity side of the balance sheet, the liabilities are going to be where we find the reserves that the Allstate is setting aside, the dollar amount that it basically thinks it's going to be paying out on claims on its policies that it has underwritten. The unearned premium is basically the money that it is not reserving for paying out as claims, but it's still unearned because the policies are still open. The other lines on its liabilities are going to be more typical to any liabilities you'd find on a company, which are going to be like outstanding payments or deferred income or even long-term debt. Allstate's total liabilities is about $95.7 billion. And we get the shareholder equity or book value of $30.2 billion by basically subtracting the liabilities, the total liabilities that it's showing from its total assets. This is called the book value of the company because it's the value of the assets that would remain if all the company's liabilities were paid. So if we look at Allstate's current share price or market cap, it's at a share price of about $113 at the time of making this video. So that means its price to book is about 1.2. Before we move on, in the equity breakdown section of the balance sheet, I wanted to highlight that Allstate has a retained earnings of $52.7 billion, which is a massive amount of retained income. And it's paid about $31.3 billion to its shareholders in the form of buybacks. That's what that line, treasury stock means. And that's why it's negative, because it's returning capital to its shareholders by paying out of its earnings. So now that we've calculated Allstate's price to book of 1.2, let's take a look and see how does this ratio compare to its history. Is this cheap? Is it expensive? And how has Allstate been doing growing its book value for its investors, if this is how the company is valued and judged by? So here is a chart of Allstate's book value and price to book over the past 6 years. First of all, it's easy to see that Allstate has done a very good job at growing its book value. In 2011, its book value was $32.56, and in 2020, the book value that it recorded was $92.92. This means that you basically would have tripled your money through pure price appreciation if Allstate would have been valued at a price to book of just 1 all the way through. And the best stat to measure how efficiently a company is going to grow its book value is looking at its return on equity. Allstate has consistently been averaging over 10%, and in recent years it's done 22 and 21% in 2019 and 2020, so 2 very, very good years. And if we look over the past 6 years, Allstate's average price to book has been about 1.4. So this means that its current price to book of 1.2 gives us about a 15% margin of safety if we were going to go out and buy Allstate right now. Allstate has been doing a very good job generating profits over the years, and it's doing a very good job on returning you a very good amount of money proportional to the amount of capital from investors that it has. Let's take a look at how the management team has been returning these profits to its investors. And a company can only do this in basically 3 different ways. When a company generates profits, it can either retain the profits in the company and reinvest it to try to increase shareholder price that way. It can pay these profits directly to shareholders in the form of dividends, which we all love dividends. And finally, sometimes the forgotten method is that the company can use its profits to buy back stock. This can help improve the financials of the company by basically taking the same level of profits and spreading it over a fewer amount of shares. It's also important to note that buybacks are a good way to return money back to shareholders because it's money that it can give back to you without you having to pay any taxes on it, unlike dividends. So this is a chart looking at Allstate's dividends and stock buybacks. The dividend in 2011 was about 84 cents a share, and at the end of 2020, it had grown all the way up to $2.16 a share. That basically means it's almost tripled in a span of 10 years, which I calculated as about a 10% dividend growth rate, which is fantastic. That's a very good growth rate on its own, but from a recent announcement that the company has made, this has gotten even more impressive. A couple weeks ago, Allstate decided to raise its dividend by 50% for the next year. 50%, which means that its yearly dividend is now $3.24 a share. This means that the stock is returning about a 2.9% dividend yield. This is really reassuring when the Allstate management team does a big dividend increase like this because it really means they have confidence in the company's future and their control over improving operations and growing that dividend even more in the future. Now, in addition, this is not the only way Allstate is returning capital back to you. It's also returning capital to an investor in the form of buybacks. Now, looking back over the past 10 years, Allstate's average buyback yield was about 6.5%. But in 2020, Allstate bought back about 7.7% of its outstanding shares, which is just a massive number. And these numbers do give me confidence and make me optimistic about owning this stock for the long term. Now, in addition to these strong fundamental reasons, I also wanted to share the story or the other reasons why I thought Allstate was a very appealing position for me to own long term. The first is that insurance companies do well in environments where interest rates are rising. Now, right now, interest rates are very low, but the government has been introducing a lot of economic stimulus into the economy, and it seems likely that when the economy reopens, that inflation and interest rates are going to continue to slowly rise as just the economic activity is picking up again. The second, as most of you know, the real estate market has just seemed to have gone crazy over the last couple years, and prices have been shooting through the roof. Allstate is in a very good position because higher prices on real estate will translate into more premiums that an insurance company will collect because the price of the asset is increasing. And Allstate is one of the largest home insurers in the nation. The third, which is a trend also amplified by COVID, is that renovations to home also help drive up home prices, and home prices will translate into higher home premiums that are collected by the insurance companies. And fourth, even though insurance is kind of a forgotten industry a lot of the times, I do believe it's going to benefit a lot from continuing to integrate technology into its company. I think it's going to help improve its expense ratio by being able to underwrite more policies with its existing overhead, so being more efficient with its admin and back office. And I also think through improved data analytics that it's going to continue to improve its loss ratio. So it's going to continue improving its margin on its underwritings, like Allstate has shown that it's been doing the past 6 years, but I think this is a trend that could continue into the future. Now, all these reasons together and in combination with the fundamentals helped convince me that Allstate was going to be a good investment for the long term. So now let's look at my positions. So these are my current positions, and when I acquired these positions for Allstate, it's a relatively small position in my portfolio right now at only 1.5%, and that is just because I started acquiring it at the end of last year. But also, even though I really do like Allstate, I don't think it's ever going to be a position that takes up more than 5% of my portfolio. And that's just because, although it's a great company and I do think it's going to be a good dividend grower, there are a lot of companies that I like to diversify myself across, and I think are also very appealing. So my first and biggest investment was in October. I invested about $2,500 at $91 a share, And this is really why my average cost basis is that $94.47. Um, because the current price is $113, I'm up about 25% in that position, and overall I'm up about 20% because I invested a small amount on a pullback that it had in February while growth was also really expensive. So in total, my cost basis is about $3,300, and the value of those positions is just under $4,000. Because of Allstate's big dividend increase, it's currently yielding around 2.9%, but my yield on cost is already up to over 3.5%, which is awesome. And it's a company that I'm hoping is going to continue increasing its dividend going forward to help strengthen my dividend part of my portfolio. Next, I'll pull up a chart to show you my entries into Allstate and basically, why I bought when I bought. So up on the screen is a candlestick chart of Allstate. Each of these candles is representative of one day. So I started looking at Allstate sometime around mid-September or beginning of October. I noticed that it was basically stuck in this channel, and that not only was it stuck in this channel, but the financial sector in general was really lagging behind the market. So its valuation was starting to get very attractive. And after I did my analysis, and I realized that it had very good fundamentals, and that its price to book below 1.4, around that 1.2, 1.1 area, was a really good entry point. So around the end of October, I saw that Allstate was near the kind of at the convergence point of this channel, where it's either going to make a move up or make a move down. To me, it seemed likely that it was going to break up just because its valuation was so cheap and it was lagging the rest of the market. And if it did break down below this channel and did fall towards the like $85 to $80 range, I would have been really happy to accumulate prices at that level as well. So I saw my oscillator in the middle was just about getting ready to rise, which is a bullish signal if you're into technical analysis. It signals that the stock is oversold at the time, so it's likely that it's going to receive a bounce. And then also its price to book when I first bought it was around 1.1, which was just a really attractive entry point. So Allstate ended breaking up out of its channel and got above all of its moving averages, which was great. And I really let the stock run for a bit. And when I had more money last month, I noticed that Allstate was pulling back into its moving averages. And at this time too, growth was still really, really expensive. So just in terms of value that I saw in all my companies, this seemed pretty attractive. So I invested a little bit there as well. And Allstate, it seems to be entering in a bullish uptrend. Right now it's at $113. But because currently now when I look at the market, a lot of my growth companies are very cheap, and those are starting to become very appealing. So although this is a company I'm very bullish on, owning long term and into the future, I'm going to try to be patient and wait for pullbacks into its moving averages before adding any more. There are a lot of other companies that are showing fear and pain right now, and those are the companies that I like to look at and to invest more in. So if you enjoyed this stock analysis of Allstate, please check out other videos on my channel. I did an analysis on Splunk, which I'm going to post right here. That is a stock that has pulled back tremendously as growth has been hurt recently. And I'm also planning to do a stock analysis on Home Depot, which I haven't done yet, but I'm going to post a link to that video right here when it's out. All right, guys, this is Mark and Matt, and I wish you the best in investing.